Welcome back. Hopefully you didn't find that last quiz too taxing. I'm pretty sure you didn't. The whole idea is to get a few concepts down, quiz you on it, and then move on to the next chapter to find out some more information. And right now we have a chapter that finally has some meat in it. The sales pitch is over in the first section. We've convinced you that you probably want to try regulatory accounting. Well, how do you get it into your books? How do you get it started? And so on. So this chapter gives the detailed steps for the initial implementation of regulatory accounting, the transactions to consider, the initial journal entries, how you restate your financial statements, and the note disclosures too. So there's quite a bit of work up front, but I think you'll find it worthwhile and beneficial for your utility. Now this might be a bit of puffing, and regulatory accounting may not be exactly unconventional. But when you look at it and you're not using it compared to using it, it's kind of like the difference between maybe a quaint English tea where everything is all organized. You have the cookies, you have the cakes. I can use food for almost any analogy, but there's a certain organization to that. And compare that to the Wild West. You're not sure what's going to happen. Every day is a new adventure and so on. So from an accounting perspective, if you want to make a loose analogy, it depends on whether you're conservative towards accounting policies or you're willing to take a run at something that you may be not used to, with the potential for a favorable outcome. So regulatory accounting may be just what you've been looking for in regards to that. Something a little different, something that fits a need, and something that maybe is a little unconventional to your utility and its operations. How does implementing regulatory accounting work? The cool thing about it is once it's set up, it becomes part of your regular business process, and it's not a special thing from year to year. You just decide which transactions are going to use regulatory accounting treatment and which ones aren't. But in the first year, there is a bit of work, as I said earlier, to get it up and running. So the process used in the year of implementation of regulatory accounting under GASB 62 or ASC 980 works like this. First, you determine the past events to which regulatory accounting will be applied. So you might have some events that have been previously recorded under the applicable accounting treatment under generally accepted accounting standards for that particular event. So you decide, well, maybe we would like to change the recognition of that event and use it under regulatory accounting, GASB 62, ASC 980, and so on. So once you've decided what those events are, event or events, you calculate the remaining balance of the event in the current year that hasn't been recovered through customer rates. What you are left with are costs that are to be recovered through future customer rates or revenues that will be recognized through future customer rates as well. Next in the process is to record the difference between recognizing the original event and current balance of the regulatory item as an adjustment to the opening balance of net position or retained earnings. And the offset of that is a new regulatory asset or liability for the event. And then going forward, you simply amortize the event in future years using the requirements of GASB 62 or ASC 980. From a financial statement perspective, the financial statements present the regulatory accounting adjustment as a change in accounting principle, and the opening balance of net position in the earliest period presented in the financial statements is adjusted for the amount of the regulatory accounting adjustment. Or you can restate the financial statements for all of the periods shown for the impact of the change in accounting principle to using regulatory accounting. So you're thinking, yeah, Russ, that was a great way to read that last slide verbatim. But how do we really do this in practical terms? Well, basically it's this. You pick the transaction that you want to use regulatory accounting for. You restate the financial statements because this is a change in accounting principle. So it's like you're rewriting past history, and going forward, you're going to use regulatory accounting treatment for this particular item or group of items as well. Here's an example of a utility. They've identified certain events now that have taken place in prior years, and now management wishes to treat these as regulatory assets and regulatory liabilities and recover these costs through customer rates. So what do? Well, the first step is to identify the transactions that they wish to apply regulatory accounting to. On this slide, you see they've identified 3 projects for regulatory asset treatment. So this being major tree trimming projects, uninsured storm damage, and unfunded pension and other post-employment benefits. So the math behind this, if you look at the second column from the left, you look at the original amount expensed in the financial statements. Then you also look at, in the next column, the amount not yet recovered through customer rates. And this will become the adjustment to net position and the balance of the new regulatory asset. In the next column over, the second from the right, the future recovery period. And then the final column on the right is the annual recovery through customer rates. So this will be the annual amount that is recognized in customer rates based on the analysis of the prior transaction. So in other words, this column is the rewriting of history going forward, and the third column from the left is the frozen moment in time when you determine this is the balance we need to recover in future customer rates. On the regulatory liability side, they've also identified three particular areas. So first is contributions in aid of construction. This would be for GASB utilities only, grant treatment, again, GASB utilities only, and rate stabilization or deferred revenues, which could be GASB or FASB utilities. Go through the same process. Next column over is the original amount recognized as revenues in the financial statements. The third column from the left is the amount not recognized yet as revenues matching the underlying event. In other words, this is the frozen moment in time that they would like to use going forward to record the future recovery period, the annual revenue recognition, and so on that you see in the next two columns over on the chart on this slide. In the previous slide, we are going to recognize $7.6 million in total of regulatory assets and future customer rates, where on this slide we have $9 million of revenues that we are also going to recognize in the future years based on these three particular items. You also have to remember that exit strategy. Without an exit strategy, you technically cannot use regulatory accounting for any of these items. So management presents a resolution to the oversight board to implement regulatory accounting for these particular items, and the board approves the resolution. So we are good to go, and we can make the journal entries that we see starting in the next slide. Now we'll go through the journal entries for the first year of using regulatory accounting. For the regulatory assets, we're going to set up three separate asset accounts. So regulatory asset tree trimming, regulatory asset uninsured storm damage, regulatory asset unfunded pension and other post-employment benefits. Account number 182 is from the FERC Uniform System of Accounts, and it is the account that is used to defer costs that are to be recovered in future rates from customers. So we set up three separate accounts for this. We see the $1 million of tree trimming program costs, the $600,000 of uninsured storm damage, and the $6 million of unfunded pension and other post-employment benefit costs. And the sum of those three, the $7.6 million, is recorded as a credit to net position or retained earnings, and the FERC account for that is account 216. This recognizes that we are taking $7.6 million of costs that we had recognized in prior years, and we will now recognize those costs instead over future years as we recover those costs from our customers through their rates. We go through a similar exercise on the regulatory liability side. We set up three separate regulatory liability accounts, one for contributions in aid of construction, another for deferred grant revenues, and a final for rate stabilization / deferred revenues. We use account 254, which is the account number under the FERC Uniform System of Accounts, used for deferring revenues to recognition in future periods. Some of these three items, which is $9 million, is recorded as a debit to account 216, net position / retained earnings, to reflect that we have recognized this $9 million of revenues in prior years, and now we're going to in turn defer recognition until future years of the same $9 million in revenues. Once the regulatory assets and liabilities have been recorded, now comes the rewriting of history. In other words, going forward, the rate recovery from our customers through annual journal entries of amortization of the expense or recognition of the revenues. You'll see on this slide the reduction of the regulatory assets for tree trimming uninsured storm damage, unfunded pension and other post-employment benefits. You'll also see the reduction in the regulatory liabilities for contributions in aid to construction, deferred grant revenues, rate stabilization, and deferred revenues. These are recorded as reductions to depreciation expense for the contributions in aid to construction, as a non-operating revenue for recognition of the grants that are used in projects, and recognition of $1 million in revenues by using rate stabilization reserves. And we'll have a detailed example on all of these so you can see how the mechanics work of the calculation of these and why the recognition of these amounts are where they are. As part of our analysis, let's take a look at the impact on rates. As we go through the course, we'll have various examples and specifics of regulatory asset and regulatory liability situations. And for each of those, we will always take a look at what the impact is on rates of those particular items. But what you see on this slide is an example of the impact on rates of the analysis of the items that we have just recorded in the financial statements. Refer back to the regulatory asset and the regulatory liability slide. You'll see these numbers in the far right-hand column. What they're saying is that for regulatory assets, $360,000 is now included as a separate expense line item in the current year budget. In other words, rates should be increased by $360,000 annually for those regulatory items. On the flip side, for the regulatory liabilities, now $1.4 million is included as a separate revenue recognition line item in the current year budget. In other words, those regulatory items, the contributions in data construction, the grants, the rate stabilization are now recognized over a level period based on our exit strategy. And based on that exit strategy, rates are now decreased annually by $1,433,333 for those regulatory items. Along with this, you now have some financial statement disclosures that need to be made. These will be made in year one, the year of implementation. You'll recognize some numbers on this slide. You see the regulatory assets of $7.6 million for future rate recovery were recorded, and $9 million of regulatory liabilities for future revenue recognition were also recorded as well. You take the cumulative effect of this adjustment and you book it against the opening balance of net position in the current year. You'll recall the journal entries we made several slides earlier with the debit to retained earnings and the credit to retained earnings as well. Then you should also disclose the detail of the items that make up those regulatory assets and regulatory liabilities as you see on the slides here. You do this in year one and the years after that have regulatory assets and or regulatory liabilities. So in other words, a reader of the financial statements will take a look at this. They'll see that number on the balance sheet and they'll say, what makes that up? Well, here's the detail of it. And plus this is good reference material for you, good reference material for your auditors as well. That's it. Piece of cake, right? Not sure if it's chocolate cake or angel food, chocolate frosting, vanilla frosting. Frosting is good, no doubt about that. But in any case, here we are. It was quite a bit of work, but now the job is done. And going forward, it should be a lot easier as you identify items, book them, and then record them in the financial statements and the financial statement disclosures. So your key takeaways from this section are this. The year of implementation of GASB 62 or ASC 980 will be active. You'll be doing a lot of work. Determining what transactions to include, calculating the cumulative impact and additional financial statement notes. But like I said, once you get past that in subsequent years, the use of regulatory accounting becomes part of your normal business process activities. It'll be part of your budget planning process, and it will not seem so burdensome, as it does in year one. And finally, this effort will yield positive results in the area of developing uniform rates and ensuring full recovery of the financial impact of significant offense. Think back to the items that we pulled onto our balance sheet from previously being expensed or recognized as revenues. All of those have a rate impact. We can backtrack, we can collect those from our customers to make sure that we are made whole as a business and that your customers are paying for their cost of service. And now it's quiz time. Remember, the quiz will build on the materials, and just completing the quiz moves you on to the next chapter. So click on the quiz, complete the quiz, admire your score, circle back, and then we will talk about some specific examples of regulatory expenses. Thanks a lot for your kind attention, and we'll see you in a few minutes.